Right now, you have $1,000 in your bank account, except you don't. That money doesn't exist, it never existed, and somehow the entire global economy depends on everyone agreeing to pretend that it does. By the end of this video, you are going to understand something that most people go their entire lives never knowing. Something that explains why prices keep rising, why recessions happen, why your savings account pays you almost nothing, and why the bank down the street is one of the most profitable businesses in human history. This is how banks actually work. Let's start at the beginning. Not 2024, not 1913, further back. It's the 1600s. You're a goldsmith in London. People trust you because you have a vault. A big, heavy, locked vault. And your neighbors, merchants, landowners, traders, they start bringing you their gold coins for safekeeping. You hand them a paper receipt in return. A note that says, this person has deposited this much gold and can collect it any time they want. Simple enough. Safe enough. Everyone's happy. But then you notice something. People almost never come back for all their gold at once. They come back for a little here, a little there. At any given moment, maybe 10 or 20% of the gold is actually claimed. The rest just sits there, in your vault, doing nothing. And you have an idea. What if you lent some of that gold out? Not all of it, just the part that's sitting idle. You charge interest on the loan. The borrower gets the capital they need. You get richer. And the original depositor never even notices, because they still have their receipt and they can still walk in and claim their share anytime they want. This is called fractional reserve banking, and it is the foundation of every bank that has ever existed, including yours. Here's where it gets strange. When you lend out that gold, you don't hand over coins from the vault. You hand the borrower another paper receipt. A note that says they have credit with you. Now there are two receipts circulating in the economy backed by the same gold. Two people believe they own the same asset. And as long as they don't both show up on the same day demanding the real thing, nobody ever finds out. You just created money. Not physically. Not by mining gold or minting coins. You created it by writing a number on a piece of paper and convincing someone it was real. Fast forward 300 years. The paper receipts became bank accounts. The goldsmiths became J.P. Morgan Chase, Bank of America, and Wells Fargo. The vault became a computer database. But the mechanism is identical. When you deposit $1,000 into your checking account, your bank is legally required to hold on to a fraction of it. Historically, that fraction was around 10%, meaning they had to keep $100 in reserve and could lend out $900. That's the origin of the term fractional reserve. They only hold a fraction. But here's what almost nobody explains correctly. When your bank lends that $900 to someone else, that person doesn't receive cash. They receive a deposit in their account. Their bank now has $900 on deposit, keeps $90 in reserve, and lends out $810. That bank lends to someone else. Their bank keeps $81 and lends out $729. And on and on and on. Your original $1,000 deposit through this chain of lending can theoretically generate up to $10,000 in total deposits across the banking system. For every $1 deposited, the system can create $10. This is called the money multiplier, and it means that the vast majority of money in circulation right now was not printed by the government, not minted by the Federal Reserve, not pulled from a mine. It was created by commercial banks making loans to ordinary people for cars and mortgages and credit cards and business expenses, according to the Bank of England, and they said this plainly in a 2014 research paper that barely anyone read. Roughly 97% of money in a modern economy is created this way. By banks, not governments. Banks. Let that sit for a second. 97%. Now you might be asking, if banks can just create money, why don't they create infinite amounts and give it to everyone? The answer is risk. And this is where it gets sophisticated. Banks don't just create money randomly. They create it when they make loans, and loans have to be paid back with interest. If the borrower defaults, if they can't pay, the bank takes a loss. Real losses. Against real capital that the bank's shareholders put in. So banks are constantly balancing two forces. The desire to lend more and earn more interest against the risk of lending to someone who won't pay back. This is why your credit score exists, not to punish you, not to reward you, to help a bank calculate the probability that you will repay so they can decide how much imaginary money they are willing to create in your name. Now let's talk about the Federal Reserve, because this is where most people's understanding completely breaks down. The Federal Reserve is America's central bank. It was created in 1913 after a series of devastating bank panics, most notably the Panic of 1907, when a failed attempt to corner the copper market triggered a cascade of bank runs that nearly collapsed the entire U.S. financial system. J.P. Morgan himself, at 70 years old, personally orchestrated a private bailout to stop the bleeding. Congress looked at that situation and decided that one old man's willingness to act shouldn't be the thing standing between civilization and financial collapse. So they created the Fed. The Federal Reserve does not create most of the money in the economy. That's the commercial banks. What the Fed does is control the conditions under which banks create money. Its most powerful tool is the federal funds rate. This is the interest rate at which banks lend money to each other overnight. When the Fed raises this rate, borrowing becomes more expensive for banks, so they charge more for loans, so fewer people borrow, so less money gets created. When the Fed cuts this rate, the opposite happens. Borrowing gets cheaper, loans increase, more money floods into the system. When you hear that the Federal Reserve raised interest rates to fight inflation, this is the mechanism. They are turning a dial that controls how much money the banking system is allowed to create. Higher rates, less money creation, less spending, prices stop rising as fast. Milton Friedman, the Nobel Prize-winning economist, spent decades arguing that inflation is always and everywhere a monetary phenomenon. Too much money chasing too few goods. When banks create too much money through excessive lending, prices rise. When the Fed tightens conditions and money creation slows, prices stabilize. It is, at its core, a supply and demand problem. But the supply being managed is money itself. Now, back to your $1,000. You deposited it. You believe it's there. You can log into your app right now and see the balance. You can tap your card at a coffee shop and spend it. In every practical sense, it feels completely real. But your bank has lent most of it out. It exists simultaneously as your balance and as someone else's loan. Two claims on the same underlying asset. This works because of one thing and one thing only: confidence. As long as you believe the money is there, and your neighbor believes their money is there, and enough people believe it collectively, the system functions. The receipts keep circulating. The loans keep getting made. The economy keeps growing. But the moment enough people stop believing, the moment they all try to withdraw at the same time, the whole structure reveals itself for what it is. This is a bank run, and it is one of the most destructive events in economic history, not because banks are necessarily insolvent, but because no bank on earth keeps 100% of deposits on hand, by design, by law, by the fundamental logic of the system. This happened in 1929. It happened in 2008. It nearly happened in 2023 when Silicon Valley Bank collapsed in 48 hours after depositors lost confidence and pulled $42 billion in a single day. The FDIC, the Federal Deposit Insurance Corporation, exists specifically to prevent this psychology from spiraling. It guarantees deposits up to $250,000 so that ordinary people never have a reason to panic and run. Because a panic, not insolvency, is what actually kills a bank. So here is the complete picture. You deposit money, the bank keeps a fraction and lends the rest. That lending creates new deposits elsewhere. Those deposits get lent again and again until your $1,000 has rippled through the system and become $10,000 worth of economic activity. The Federal Reserve controls how aggressively this multiplication happens by adjusting the cost of borrowing. And the whole system runs on the collective belief that the numbers on the screen are real. They are real, in every way that matters. But they are also, at the deepest level, a shared agreement. Money has always been a shared agreement. Gold was a shared agreement. Paper was a shared agreement. The number in your bank account is a shared agreement. What changes is not the nature of money, but the technology we use to maintain the agreement and the institutions we trust to uphold it. The $1,000 you thought you had this morning? It was never sitting in a vault with your name on it. It was always something more interesting than that. It was a promise backed by an institution, insured by a government, enforced by law, and sustained by the collective confidence of 330 million people who show up every day and agree, without thinking about it, that the number on the screen is worth something. And that agreement, fragile, invisible, and almost impossible to explain, is the thing your entire financial life is built on.